And just like that, we're back. The generational low of 2024 March is in and we're up, up and away. Or are we? Despite the bullish price action, there were major red flags flashing in regional banks. York Community Bank Corp was halted in trade today after news of a cap raise sent fears of a liquidity crisis reverberating throughout the sector. But those fears were all but quelled after finishing green on the day. So should we be concerned? Today, we answer that question and also talk about the current state of the labor market, Jerome Powell's testimony, and where the S&P 500 will go next. We have a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell. Like this video, guys. It really helps me with the algorithm. Let's roll the tape. What a bounce back led by the obvious leaders in the market, semiconductors, but a very green day across the board. In fact, the markets could have been significantly stronger if some of these big names did participate, but Microsoft, Apple, Google, Amazon, Tesla just didn't really participate in the action, and that did drag on the index. All in all, very green across the board. There were a couple of really weird, look at financials, industrials, real estate, energy. Everything was really green. Defensives, healthcare, we had risk on assets green, defensive assets green, sensitive assets green. Right here, there were a couple of huge red flags in the market that we have to talk about. Regional banks, absolutely crazy the action that's going on there. We're going to talk about them a little later, but let's actually hop on the charts and see what the S&P 500 did. Now, looking at the major sectors, we can see that the S&P 500, RSP up 0.5 percentage point. We saw the NASDAQ right here, and mid caps up 0.6567%. Small caps 0.3, IWM 0.75. So it was a broad-based rally. The VIX up ever so slightly. So volatility did increase as the market went up, VIX up, stock up, and then, gold didn't do much. And crude up 1.25% in excess, and then crude up. But zooming in on the S&P 500, what did we do on the day? So at the start of the week and yesterday, we said we were looking at two major points of contention. It was, this 5100 area, which was resistance right here, turned support. It broke yesterday, and in this area, support zone right here. We said buyers were going to come in right here. That's exactly what happened. And then they actually followed through overnight. We gapped up. Now looking at this graveyard doji, it is a red bodied candle, but you have to understand the fact that we actually gapped up. Now looking at the 5-minute chart and seeing what the market actually did intraday. So here's the gap up, right? And then we actually had price discovery lower. I think a lot of this had to do with what happened in regional banks. We're going to talk about that in the video. Then, the market brushed that off. We rallied, and then we sort of formed this double top right here and moved lower. And we see dense price action. When you see price action like this, right? Whipsaw price action in the market. This is like big money coming in, like they're just huge block trades are trading at the zone right here. I would love to see, can we actually get volume? What did the volume look like? It's really hard to see, but you can see from this point right here, volume did slightly increase into the end of the day. And I think that's what happened right here. So tomorrow, this is going to be a very big zone. Let's actually just mark this out, and then we'll go on the daily chart. So right here, call it right here. So that area is sort of like in the middle of our trading zone. So a couple of things to note, right? If we go on the daily chart, we can see that the bottom of this candle and right there, the top of that candle, very dense trading zone. I would watch the top and bottom of this zone tomorrow. I think whichever way we break, that's probably where we're going to go. Let's say break above, right? We're probably going to stay above it for the day and rally, maybe even go ahead, close this gap because it's not quite closed. If we break below, we probably have price discovery to yesterday's close. So very dense trading zone there in the 5-minute chart. At the end of the day, what do I favor? Well, we could see dip buyers came in right here. Dip buyers came in right here. Sellers did come in at the top. That's a big wick right there. I think a lot of it had to do with regional bank flows as well. And, some of the mega caps just not participating. But what do I favor? I think higher price action is probably where we're going to go. Number one, because this is actually an equal low at this level right here. But then you look at this level, it's a higher low. This level, it's a higher low. So this is constructively bullish and probably the next level of support to watch. So if we do pull back tomorrow, look at this area. We do bounce here. That's constructively bullish. We don't want to break below, but I do favor higher price action just because this is setting up to go higher. Sure, we got a lot of selling at the top here based on what happened with York Bank Corp today, and we're going to talk about it in the video. We should be below this point. We're not. That's bullish. In a normal market, it would be a viciously red day after the situation with regional banks. So why did the market rally? Well, it was a couple of reasons. Jerome Powell was at Capitol Hill giving his testimony, and when he says stuff like likely appropriate to cut rates sometime in 2024, he's giving us a deadline. The whole topic of rate cut conversation is not if, but when. And so, he's kind of giving us a when signal. But the market sees this as very positive. Secondly, ADP data came in a tad weak. We were expecting 143, came in at 140K. That might mean we're not going to get like a blowout NFP like we did last month. And also job openings came pretty much in line, a couple thousand weak, but pretty much in line. And so essentially what this is telling us is the economy is not overheating. We are going to get rate cuts in 2024. Labor market still quite tight, relatively speaking, but not like exploding like it did 12, 18 months ago. That's a really, really good sign for the stock market. All in all, economy not in amazing shape, but not in bad shape either. And that's why the market rallied today. Now, looking at sectors, crazy action. Look at regional banks right here. Got absolutely whipsawed. I think down like 4-5% at one point. But what was the craziest thing about it? But then we actually have a look at stuff like real estate, XLRE, XLF. They traded completely fine today, which means the problems with regional banks are exclusive to regional banks and actually just one specific bank, New York Bank Corp. The best performing sector, guys, GDX. I think GDX is up like 13% since I gave it to you guys or something like that, something crazy. Semiconductors up 2.6% today. And then, it was a very mixed bag. We had like metals up here performing, software as well, utilities, home builders. So very mixed day of trade, no real leaders. I mean, semiconductors, sure, but then you look at where technology was, staples, software, metals. It was a mixed bag across the board. And almost every sector gained except regionals and discretionary based on just the flows from Tesla. But let's actually talk about New York Community Bank. Couple of things we need to discuss. Number one, the stock was down 40% at one point during the day, up 8% to finish the day, up another 6% in after hours. Down 40%, that's a bit of an overreaction. Probably a lot of people scooped in right here, 0 DTE buyers, and took this all the way back. It was halted for trading volatility, but there's a couple of things we need to note. As I mentioned earlier, the XLF didn't really move, XLRE didn't really move, and rates didn't really move. So it seems like this regional bank situation is exclusive to New York Community Bank Corp. And this just comes with the fact that they bought Signature Bank's assets. And that's really what's causing them stress and why they need more capital. But for the most part, this does seem isolated and it doesn't look like it's spilling over into any other sectors. If we were, we would have seen financials down big, real estate, XLRE down big, and we would have seen yields spike up. We just didn't see that today. And all the signs are telling me that this is just isolated. Now that could change at any moment and I will keep you guys updated if that does change. So go ahead, subscribe to me so you get the latest updates here on YouTube and Twitter. Go ahead and follow me on Twitter or X. Now let's talk earnings. We had a couple of big name earnings today. We had Foot Locker and Abercrombie Fitch. JD also reported earnings. I think they were up 11%, beat on earnings, $3 billion cap raise, increasing dividend. Really good earnings right there. So, a bit of China strength for the most part. Campbell's did really good as well. Actually, really good earnings today. But let's talk ANF and Foot Locker. Now, Abercrombie Fitch, they beat on EPS, beat on revenue. Their outlook wasn't that great. Everything else came pretty much in line. Foot Locker beat on EPS, beat on revenue. Sales, comparable sales in line. They're not resuming their dividend. Market didn't like that at all. Also, their guidance was not that great. Very, very weak. This is what the stock looked like on the day, down 29%. You know what's crazy about this? At the start of the year, Jim Cramer said this was one of his top picks. Foot Locker, rough situation for shareholders. If you bought the stock at the start of the year, you were down, I think 35% plus on your initial investment. So people didn't like the Foot Locker story. They're not liking where it's going and the stock continues to be a dumpster fire for shareholders. Now guys, I wanted to bring some important stats to your attention. This is S&P 500 performance in the 12 months after a positive December, January, and February. Let's call it the trifecta. Now we can see here, this has happened 25 times, 25 individual years. This has happened 25 wins, 0 losses, a perfect record, average return 16% in the full year after the positive trifecta. Now have a look at the max drawdown here. The only year, 2011, we had a max drawdown of -7%. That was the only double-digit drawdown right there. Every other year, the max drawdown was in the single digits, and the max draw up was almost double digits in every single occasion. Only 1, 2, 3 times was it in the single digits. And even then in 2011, had you bought the low right here, sold at the top, your returns would be 20% in that period. Now the reason why I also wanted to show you this was after the sell-off we had on Tuesday, that March can actually be negative. If we actually have a look at up years versus down years right here for March, we normally have 17 up years, 8 down years. So 1 in 3 times out of this trifecta, March is going to be negative. So we could definitely get a negative March, and that would just be a dip buying opportunity for outsized returns 12 months later. And this is why I'm a big buyer of stocks right now. So this is a screenshot from my phone, from my broker. This is just a NASDAQ 100 ETF here in Australia. The ticker is NDQ, exactly the same thing as the QQQ. These green dots just represent every buy trade I've taken. And as you can see, I actually am currently a buyer of NASDAQ 100 ETF for my ETF portfolio. Now, many people will think I'm crazy for actually being a net buyer of stocks at these levels right here and at these valuations, but many people called me crazy right here. In fact, right here, sentiment was in the dumps. I remember people were looking at 2022 lows, 2020 COVID lows. It was very contrarian to be a buyer here in late October. And if you go back to my videos in late October, there was like 3 or 4 videos where the market was like falling. We were like in this time period right here. It was like a week or two, and I said, guys, you want to buy with everything you have, mortgage your house, do whatever you can to get a bit of money, buy the dip. Those videos are on my channel. I have not removed them. You can go have a look at them. I literally tell you guys to buy the dip right here in the S&P 500, and we went on a blockbuster rally. And I think the contrarian view right now is to continue to be bullish. I think there's a lot of like bears not believing in the rally. I think the contrarian view is to believe in the rally. And I think the stats back that up. All of the stats that I show you guys, everything is like longer term charts. And all these stats are pointing to bullish momentum. I think the economy is in an okay position for stocks to rally. And as long as earnings come out good, the fundamental picture is clean, the technical picture is clean. And the only thing that's going to derail anything in the market right now is the macro picture. And I don't think that's going to happen in an election year. And so I do think that the contrarian view right now, guys, is that we go higher and we just kind of just do this in the NASDAQ and S&P 500. I know it seems crazy. It seems like we can't go any higher, but that is my view. That's what I think. And that's why I'm a heavy buyer right now in stocks, individual stock names that I like, as well as NASDAQ 100. And we may go down, we may go lower. I'll keep buying. The lower we go, the more I like stock. Now guys, let's talk price targets. So we've had a bunch of price target upgrades that we've covered from UBS to Goldman Sachs. We've covered a bit of BofA's as well, but I got their official S&P 500 target here. They went from 5,400 to 5,000. Now we already knew that, but here's how they got there, right? So they have a bunch of models. They have their fair value model, their sell side indicator. We covered that in yesterday's video, so go check it out. Earnings surprise indicator, long-term valuation model, and then a momentum. So it's based on some fundamentals, technicals, macro as well. And you can see this is how they weight them. This is their target. This is their expected return from the current price. And if you add it all together, weight it accordingly, they get a 5,400 price target, 6.2% from the current price. And this is how their forecast for the full year implies a 13% increase from January 1st to December 31st. Very interesting stuff from BofA right here. And if you guys have been following me since the 1st of January, I actually put out a video. I said my end of year target was 53.84. This was back in January when the highest target on the street was like 4,700. And I do think that 5,400 is probably the target where we're going to finish the year. We were the most bullish target on the street, except for maybe Denny. We were even more bullish than Fundstrat, and it does look like 5,400 by the end of the year is very, very probable. Now let's look at the labor market, something that we always need to keep track of, because there's 3 parts of the economy. We need to look at the first part, which is the macro, the second part, the fundamental, and the third part, the technical. Now in the macro, there's 3 major players. There's the consumer, there's the government, and then there's the Fed. Now the labor market fits under the consumer. It fits under with consumer spending, and we really do need to keep track of the consumer, of the labor market, just to see how healthy the economy is. And that's why we keep track of the consumer employment data on this channel week in, week out. Sometimes I may even go on about it too much, but it's just that important. And what we can see, employment in at least local education is at the COVID levels and likely to go higher in 2024-25. At the same time, now private employment is also broadening out. High touch services was the major contribution to private employment, but we are starting to see this trend broaden out right here. Very, very healthy. At the same time, we're seeing posted wages are easing, but reported wages have actually remained stickier, so it's sort of trending flat, and that's what you want to see. Sure, it does make inflation a little bit more stickier, but people having more money in their pockets with inflation coming down and more real income, more disposable income is actually good for stocks in the long term. Sure, there may be short-term hiccups, but in the very long term, people are making more money. It means the economy is just better, especially if that money translates into real terms, excluding inflation. And then we're also seeing labor force participation at the same time right here pick up. And I actually do expect this to increase, especially as we do see demographic changes occur significantly in the world now. I am looking years and years out. This chart goes back to 67, but that's what I'm seeing. The demographic shifts and the aging population, we should see this tick up in labor force participation. Is that a good thing? Is it a bad thing? Yet to be seen. That being said, that's my prediction. Now, we are getting employment data on Friday, non-farm payrolls data. Now, BofA expects non-farm payrolls to rise to 215,000 in February. This is 100,000 right here. Goldman Sachs expected 100K average throughout 2024. Now, guys, if this number comes in between 210, 215, I think that's going to be good. In fact, if we do get 210, that might actually be a little bit better. The jobs report last month did come in very hot. We were expecting 180. We came at 353, and then we had that massive one-day sell-off where we automatically bought the dip the next day. So as you can see, short-term weakness if we do get a hot number, but generally speaking, investors realize that, hey, more people employed just means more real disposable income, and that's better for earnings as a whole. That being said, if this number does come in hot, we can see a mild sell-off, especially with the flows we saw in yesterday's trade. However, if it is under 200K, that can also be seen as maybe the job market is softening too quickly, maybe things are too tight. So it's a good balance. I think anywhere from 210 to 215 is probably the way to go. Now, guys, let's talk about the macro. Now, this is very interesting data from Goldman Sachs right here. They say rate cuts tend to be faster if inflation has fallen below target, growth is slowing, and if central banks are further away from neutral. Now, inflation hasn't fallen below target, growth is not slowing. Now, how far are central banks away from neutral? You could argue either way based on the economy. That being said, in soft landings, we actually normally do get 3 rate cuts. That's what the market is pricing in right now. That's what the Fed dot plot says right now. And I think that's what we should expect. Big question is when? June, July, December 2025. And that's why the market is reacting the way it is right now, because it's not a matter of if, but when we get these rate cuts. Now, during a Fed cutting cycle, where should you be positioned? Now, according to history, in the 12 months following a Fed cutting cycle, healthcare, staples tend to do the best, and the worst sectors to be in tend to be technology right here, as well as financials. Now, do take this with a grain of salt, because this isn't normalized for recession, soft landing, or no landing, because what we normally see is that when the Fed does cut rates and we do have a soft landing on average, we actually rally quite significantly after the cut. And then when we do get a recession, this is what we normally get. We normally have negative returns 12 months later. Now, guys, looking at gamma, the 5200 strike continues to be the biggest strike here on the EJEX map. 5,000-ish continues to be the gamma flip zone, and we just haven't been able to get below it. We kind of bounced off this gamma flip zone, and when we do have price discovery below it, we sort of like get back into it very, very quickly. So there's very little conviction in the bears. Now, we are seeing a tiny bit more of conviction coming to the tape. We can see right here with negative gamma being placed higher up the tape, as well as some positive gamma here below. That does mean there's a bit more conviction in bearish calls. However, until we actually get this call gamma strike move down to the 5100 and then to the 5000, the most likely outcome is that we do travel higher in a positive gamma environment where we buy dips, sell rips. Now, for those of you that don't know what this is, I just assume you all know. It's essentially dealer hedging flows and what dealers have to do at every single price point. So here at 5200, dealers will need to hedge about $1.5 billion worth of S&P 500 contracts to keep their delta neutral. And the reason why they want to go to this level, they want to take price there, is because they want to hedge their books and they want to get to a neutral delta level. This is where they do the most hedging, and that's why at these call resistance strikes or these put support strikes, normally in a positive gamma environment will travel to them. In a negative gamma environment will go towards these strikes right here, 4800 on the downside. Now, where are we in the cycle? Now, this is just a typical cycle I follow. It's the framework by Jem Carson. Very, very effective. I really, really like it. And it just gives us a visual representation of where we are in the market. And normally what we do see is that Vanna and Charm flows, which is dealer supporter flows, are strongest in week 1, 2, and OPEX week in the market. So we're sort of in here at the moment. March is a really weird month. So we're kind of in the middle of week 1 and week 2 in the trading period. And essentially, whatever environment we're in, Vanna and Charm is going to support that environment. So for example, right, if we are in a negative gamma environment, it probably means we go towards the downside into OPEX. If we're in a positive gamma environment, we're actually going to move higher into OPEX. We are in positive gamma right now, ever so slightly. Risk is to the upside, and that's why you kind of want to be long into Vixpiration, into OPEX. And then when the window of weakness comes, that's when bears can look to take their stand. But as it is right now, with where the market is, how we're positioned fundamentally, on a macro basis and technically, risk is to the upside all the way into March OPEX, the big quarterly OPEX. After that, we can look at downside opportunities into April, and then I do think we're going to move higher into April. So, bears are going to have a very short period here, about a week and a half, maybe 2 weeks to really get things going to the downside, and we'll have to break key levels for the market to really get moving to the downside. Otherwise, in this period, we're going to look for dip buying opportunities. And for the most part, I'm even buying right now. Just a bit of options framework for those of you that didn't know. Now, guys, I got some technical charts from BofA for you guys. We look at these every single week simply because these are the charts that the big boys are looking at. 78% of fund managers have access to BofA research. So for us to look at these charts, and we can get a little bit of an inside scoop as to what they're doing or what they might do. Now, this is high beta versus low volatility, and we can see here that there's been a huge base formed in high beta versus low volatility, where both of these indexes pretty much remained flat. They performed just as good as each other. However, we are starting to see since 2020 high beta break out of this base. We moved up significantly, formed a base here, and are now attempting to break out again. And we can then assume that high beta, if this breakout is to occur, high beta will outperform low volatility in the next 12, 24, and 36 months. This is a very long-term chart. You could see here that it goes back to 1999, 2000. And that just means stuff like tech, discretionary will continue to outperform against stuff like utilities. Now, looking at the S&P 500 equal weight relative to the market cap, the SPW has continued to lag the SPX, but briefly probed to a new low below the relative lows from 2020. So we probed right here relative to these lows right here. This, for a contrarian, this could be a failed breakdown, bear trap, or undercut lows from where the average stock can achieve leadership relative to the larger stocks. Do I think that's going to happen? No, I don't. What do I think is going to happen? I think we're probably just going to trend sideways in the equal weight versus S&P 500. What does that mean? It means that the average stock is going to perform just as good as the larger stocks. I think they're going to perform roughly the same, and that's how we see a broadening out in 2024. Russell 2000, IWM shows a bottoming formation from the 2022-2023 lows. A decisive move above 205 would confirm this. Bullish setup for upside potential beyond the first resistance 208, 212 to 230. So essentially, big move to the upside from 205 into 208, 212 would then bring the upside target of 234. If we can then go break above, use as support, and then rally. However, a breakdown, we could actually see support at 200 or 190 to 187. But this is the last leg before we go back to these lows right here. So we are looking to move above to this 208, 212 level first, and that would be the likely outcome. Otherwise, this big, huge multi-year base just continues for the Russell 2000. Looking at the Russell 2000 versus the S&P 500, small caps remain in a downtrend versus large caps. The risk is that the Russell 2000 remains within a bearish trend versus the SPX and needs signs of a relative bottom. What does a bottom look like? Well, it just means you form higher highs, higher lows, or you don't undercut this low. You sort of just trade in this range. Once we do that, we can then look to higher levels right here, here, and here in the Russell 2000 against the S&P 500. Now, looking at the S&P 500 and the 28-month Williams percentage R, very interesting stuff here. A persistent overbought above the -20 on the 28-month is bullish for the S&P 500. You can see here that when we went into periods of overbought on this indicator, the Williams percentage R, we actually go on very strong rallies that last multiple years, as you can see right here. And in November, we just clicked overbought, and that means if we stay overbought, we could actually just keep rallying in the S&P 500. Is that going to happen? It might not, but history tells us it's more likely than it isn't. And in almost every single instance, we did briefly probe out of overbought levels. So if this does come down and probe here, 100% normal. It's just a little bit of a breather that we do get in the market. Now, continuing with that, looking at the stats, in years when the monthly Williams percentage R was overbought from Jan to December, the SPX is up 100% of the time with average and median returns of 19%. So that's from November. That would indicate S&P 500 at 56.75 and 55.70 respectively. Average and median pullbacks that occurred during these years were 6.4 and 6.9% respectively. The biggest pullback was 10.8%. So we get fairly muted pullbacks, single digit pullbacks right here, only one double digit pullbacks in all of this data points right here. But then we get absolutely outsized returns in excess of 19%, median returns 16%, max at 45, 100% of the time higher. And this is why all pullbacks should be looked at as dip buying opportunities. And I would look at 5%. Use 5% as a gauge. Every 5% this S&P 500 does go down, use it as just a dip buying opportunity because you might not get another. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment. It's really good for the algorithm. Cheers.